In 2014, the IRS approved the use of annuities in qualified retirement accounts. The rub, of course, is that these had to be deferred and you could only use a SPIA, a single premium income annuity. There could not be any market risk, so you were not allowed to use variable or indexed annuities. So let's talk a little bit about this source of retiree income and see whether your client can actually maybe do a little bit better. So what is a qualified longevity annuity contract? Well, like I said, it's a SPIA, single premium income annuity, that you can defer, typically for about 20 years. Clients can wait till they're 80 or so, maybe 15 years, but most of the time we usually look at an age of around 85. So you fund it at retirement at roughly 65, wait till you're 85. So we use a 20-year horizon when we're discussing these. Clearly, the contract has to be held in a qualified account, IRA, 401k, 403b, that form. Only a maximum of 25% of qualified assets or $130,000 can be put into a QLAC. So 130, 260, 5. So if you have more than 500,000 in the retirement fund, however, a husband and a wife can each invest their own separate retirement accounts into QLACs. So as a couple, they could have a combined total of up to $260,000, which is a nice sum. And of course, QLACs end up being sheltered from RMD calculations. So if you think about this, the minute that you buy a qualified annuity contract, it's as if the IRS has removed the amount that you put into that contract aside until you actually start collecting on it. So say you had $600,000 in your retirement fund. Then in year one, when you turn 70 and a half, you would have to claim $21,900 for IRS purposes, taxable income. But if you had put $130,000 into a QLAC, then you would only have to claim $17,150 instead. So you get to push back the amount of money that you're going to be paying taxes on. Of course, when you do start to collect, you're going to be paying taxes, but it won't come till much further down the road. So what are some of the uses? Remember what I've said before, is that the retiree's number one desire is to have a safe, secure, sustainable income until death. So obviously, a QLAC reduces the risk of running out of money. That's the biggest use for them. Also, you get a higher return than you would for bonds or even for an immediate single premium income annuity. What you get is the benefit of mortality credits. What this really is that there's an actuarial assumption built into annuities that a certain percentage of annuitants will die before the deferral period is up. So there is amount of income, though, that's been earned off of those premiums. So what the annuity company will do then is to take that income still, and it will allocate the full balance out to those people who they assume will still be alive at, say, age 80 when you start that payout period. Obviously, the longer you wait to start to collect, the greater the deferral period, the higher the return when you do actually start to collect. As I said before, the RMD related taxes are deferred until maturity. And these two reasons are kind of linked. You improve your liquidity in retirement. Now, this is an odd thing because we're worried about QLACs that they reduce liquidity, but as you'll see in my example in a second, they actually might improve liquidity a little bit because they allow increased spending of assets until that maturity date. So let's assume that we have $750,000 in a retirement fund, okay? And we have a person, a retiree, who's worried about living until they're 100. So that's going to be 35 years of retirement if we assume they retired at 65. So if we make an assumption also that the returns that they're going to get are roughly 6% and that the inflation rate is 3% because they want their returns to grow with inflation, then you can only spend roughly $22,300 a year over time before you eat up all of your principal. But say this was a married person, and this person and their wife, they combined everything, and let's say they put $250,000 into a QLAC. One is 120, the other for 130. So now they still have $500,000 available for spending, but they've reduced their horizon from 65 to 85, down to just 20 years instead of 35 years. Over that 20-year period, they can still spend $32,500 each year. So they've almost increased their income available each year by $10,000 by using a QLAC. So you can see why I said that it improves, ironically, the liquidity until, of course, the maturity comes. So what are the risks? I think that the biggest one is that there's a negative internal rate of return prior to age 87, not even 85, because you have to start collecting. Remember, you're not going to get anything back other than perhaps principal if you choose to do that, which is going to say if I die before my annuity matures, then you're going to get a lower return over time. Obviously, that's part of the trade-off. But even if you do, you get a return of principal, you're still not going to get any of the income. So regardless, you're going to have a negative internal rate of return over time until you collect, and you have to have collected long enough to finally see a positive rate of return. Working on top of that is the mortality risk. What are your odds of still being alive when you're 85? Well, it's 40% if you're a male, 50-50 if you're a woman. How about for 90? You can see the mortality risk starts to increase more. The odds are 80% odds you're going to be dead at 90 if you're a male, 70% if you're a woman, and by 95%, only 6% of men are alive and 12% of women. So you can see that that whole issue of mortality works against you or your heirs. Another issue is inflation. Annuities have a fixed return. Okay, so if the return is $3,000 a month that you buy that annuity today, that's what you're going to get in 20 years, is $3,000 a month. The problem is that a dollar today at 3% is only going to be worth 55 cents when you're 85, 48 cents when you're 90, and 41 cents when you're 95. So you can see inflation is working against you. The premium for QLACs run between 2 to 3%, depending on what insurance company that you use and the rate that they guarantee. And like I said, there's a loss of liquidity, at least for that annuitized portion. So that goes away. So let's take a look at an example. Let's assume that we've got somebody, a male, 65, and he purchases $130,000 of a QLAC. Now we can estimate